South Africa's SARS targets 6 million crypto users. With tax audits, the South African Revenue Service plans to audit as many as 6 million local crypto users. Backed by a draft tax guide it published on July 1, 2026. Cointelegraph flagged the enforcement push on July 5th, and the draft guide is open for public comment until August 31, 2026. After that window closes, SARS has signaled that enforcement tightens. The number is striking because of its scale. Estimates in the draft materials put South Africa's crypto user base at 5.8 to 6 million people, in a country of about 63 million. SARS is not describing a targeted campaign against large traders. It is describing a compliance program aimed at roughly 1 in 10 citizens. A draft guide that doubles as an audit warning. The July 1st guide sets out the foundational rules. Crypto is treated as an intangible asset, not currency, and gains must be declared whether they come from trading, mining, staking payouts, or barter transactions. That position is not new. SARS has said for years that normal income tax rules apply to crypto assets. The difference now is the machinery behind it. SARS has stood up a dedicated crypto revenue augmentation unit to track and audit digital asset activity, modeled on the segmentation approach the agency already uses for other taxpayer groups. On top of that, South Africa adopted the OECD's Crypto Asset Reporting Framework on March 1, 2026. CARF automates data sharing between tax authorities across borders, which means an offshore exchange account or wallet is no longer invisible to Pretoria. Taken together, the draft guide, the new unit, and CARF form a sequence. Publish the rules, build the audit team, plug into the global data feed, then start matching declared income against observed activity. Trader or investor decides the rate, 18% to 45%. The tax hit depends entirely on classification. Per Bitcoin.com's coverage of the draft rules, frequent trading gets treated as revenue and taxed at marginal income rates between 18% and 45%. Long-term holding falls under capital gains, with an effective rate topping out around 18% for individuals. The line between the two is not something the taxpayer picks. SARS decides based on transaction frequency, holding periods, and intent, which is exactly the kind of judgment call that audits exist to make. One detail in the draft deserves more attention than it is getting. Crypto-to-crypto swaps are taxable disposals at local market value. Moving BTC into a stablecoin like USDT or USDC triggers a tax event even though no rand ever touched a bank account. The same logic applies to spending. Paying for groceries with a crypto card is a disposal of the asset at the moment of sale, and every one of those small disposals belongs in a tax return. For active users in South Africa, the record-keeping burden compounds fast. The August 31st deadline is the cheap exit. SARS is pairing the audit threat with an off-ramp. Taxpayers with undeclared crypto gains can use the existing voluntary disclosure program to come clean before an audit letter arrives, which typically reduces penalties substantially compared with being caught. Once a taxpayer is selected for audit, that door closes. The public comment window on the draft guide runs to August 31, 2026. Industry groups will argue over the treatment of swaps and the classification test, but the enforcement architecture, the audit unit, and the CARF data pipeline is already operational and does not depend on the guide being finalized. South Africa is following a pattern visible elsewhere. Publish detailed rules, then lean on international data sharing to enforce them. Brazil is tightening stablecoin transfer oversight, the UK's FCA has moved to binding crypto standards, and Taiwan just passed its first dedicated crypto law. Emerging markets with large retail crypto bases are no longer the soft jurisdictions they were in 2021.